I'm Greg Hunter. Welcome to USAWatchdog.com. Going to get right to it with our friend Karl Denninger. Karl Denninger, how you doing? From market-ticker.org.
Oh, I'm doing great. It's we're having a little bit of global warming down here in Florida, and I love
it. Well, I want you on the screen when I put up this headline, and this is a headline from Charles Hugh Smith. But coming Great Recession, brought to you by Health Cartel, and another one that is on there, and see your face because you can look there smugly, and it says Health Republic is latest healthcare op-ed to go under, basically, and this is the 12 of 23 of these healthcare co-ops to go under, 12 of 23. And you said that Obamacare was a disaster. You read the bill ahead of time. You said it many times on this channel and on your own market-ticker.org. Tell us how Obamacare is doing, and is it killing the economy even more every day?
Well, of course it is, but the real problem is that healthcare is commonly it's a service, right? It doesn't make anything. It is a service. And it's a non-productive use of economic output as a result, because all services are. If I cut your hair, that doesn't actually add anything to your value. It just means that you look nicer, at least in your opinion. If the doctor fixes you, you might be able to work where you otherwise would not be able to work. But in the general sense, services they do not add anything to the economy over the long term. They're consumption. And so healthcare has turned out to be about 20% of the economy. That's up from about 3 or 4% back in the 1960s and 1970s. And this is a pattern that is just a drag on overall GDP. And then what we took was a cartel arrangement that had been growing in power over the previous 20, 30 years, and then took the government and added force to it, which is the worst possible thing that you can do when somebody's a monopolist. You give them a gun and say, go ahead and shoot anybody that tries to oppose what you're doing. And so this is what's happening. The Democrats are saying, well, but look at all these people that didn't have health insurance, now they do. The problem with the Republicans from the other side of the aisle, the so-called conservatives, is that they're not willing to take this on either. You haven't heard anyone from either party, certainly running the 2016 elections, that has made a serious attempt to say, look, we have to put a stop to the monopoly behavior. And by doing that, we'll collapse the cost structure. And by doing that, we will free a tremendous amount of capital for both capital investment and goods production, which is what actually powers an economy. But you do that, and the pharmaceutical companies come after you, the health monopolies come after you, the doctors come after you, the hospitals come after you, and your opponents all start running ads of you pushing grandma in a wheelchair down the stairs, which, by the way, was an actual ad that was run when Bush was running for president by the Democrats. That said that any change to Medicare was that, and it was a very effective advertisement. It was a stick figure grandma in a wheelchair being pushed down the stairs. So that is the rhetoric that gets played by the people on the other side of this. But you only have to look at what's happened here over the last few years. The tax inversions, the mergers and acquisitions have gone on, which has consolidated market power, and the rise of these drug companies that are jacking prices on out of patent medicines by 500,000, 3,000, 5,000%. How do you sustain a price increase of 10 times with an off-patent product that anybody can produce, because there's nothing lawful to prevent you from doing it, other than through some sort of regulatory framework that makes it uneconomic?
The Obamacare, is it going to implode? Is it just going to cease at some point? Because if these health co-ops go under, and United Health Care is also out of the Obamacare, says they're going to be out of the business, along with many others. If they're out of the business, isn't Obamacare on its way to imploding?
Eventually, yeah, because what happens is that you have people like myself, and I'm in that age bracket where it starts to get expensive, right? Because I'm over 50, but I'm very healthy, so I don't have need for a doctor on a routine basis. I'm essentially paying so-called health insurance against the possibility that something really awful and catastrophic happens to me, which is unlikely, but it could. And as long as the price of that insurance is reasonable, I'm willing to go ahead and pay for it. The problem is if I have to pay for the person who is 300 pounds, diabetic, won't do anything about that, and just demands to be pumped full of pills and other sort of medication and treatment, and because I'm forced to buy, I am forced to subsidize that person's coverage, then at some point I say, you know what, I'm going to pay the fine. Okay? Well, if you don't have any healthy people in an insurance pool, if everybody that buys homeowners insurance is an arsonist, you're not going to be able to afford homeowners insurance. All right, and so that's basically what's going on here is we have people, some of whom are sick through no fault of their own. I know there will be people who say, oh, you evil SOB, this person got cancer, they didn't have anything to do with it. That's true. However, the majority of the money we spend in healthcare is jacked up due to these monopolist practices, which raise the cost by 4 or 5 times where it ought to be. And on top of that, we are being forced to pay for people who have made lifestyle choices that dramatically raise their cost of healthcare. And so those of us that have not made those choices and don't want to support monopolists at some point say, you know what, the bargain's not worth it. I'll take my risk of dying due to having a heart attack tomorrow, you can just go screw off. And the health insurance companies are faced with an untenable problem because if the only people that buy insurance against car accidents are people that wreck one car a year or more, you're not going. The cost of car insurance is going to be $20,000 a year because that's the cost of the car, right? So, so this is what ends up happening is that the people that use the system very heavily and spend $10,000, $15,000, $20,000 on healthcare, if they're all that's in the pool, that's the price of the insurance.
They noted that in the article with this co-op that some people paid way too little and some people paid way too much. Those are the people that are saying, I'll pay the tax, I'll pay the penalty.
Right,
I'm out. I might as well just be out and get health care when I get sick.
Well, yeah, and that's the thing is that for someone like me, I can cut my income back to the point that the subsidies make the catastrophic coverage against something really awful happening reasonable, but this is something that a lot of people just, rationally can't do. If you have a family, that exemption disappears when you get to around $40,000, $50,000 a year in income, and now you're forced to pay the full boat for the cost of the coverage. When you're forking up $10,000 or $15,000 on an annual basis, and then you have a $6,000 deductible on top of it, so basically you bought catastrophic coverage. It doesn't cover anything routine at all. What you've effectively done is extracted $10,000 or $15,000 from everybody in America to pay for the people that are sick. Well, if I'm not sick, I'm not going to spend the $15,000 because I don't get anything for the $15,000.
So do you think this is killing the economy? This is part of what's killing the economy. I mean, obviously, you said that this would be an economy killer, and sure enough, all the arrows on the economy down, 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 down. Everything's down. The Democrats are freaking out with Yellen begging her not to raise interest rates in the election year. Is it killing the economy? And are we going to get an interest rate rise? What's Yellen going to do?
Well, it is killing the economy. But, the thing is what people don't seem to understand is that the vast majority of Americans get their health coverage through their job in some form or fashion. Right? But the rate increases that are being shoved down employers' throats are astronomical. I'm seeing this cycle around, I'm seeing increases of 20, 30, 40, 50% for inferior coverage. And so, people look at this and say, well, how could that happen? Well, the way it happens is you underprice risk the first couple of years because you don't want to drive everybody out. And then the reality hits and you have things like what's happening with United Health where they come back and say, look, we just can't make any money at this price, so the price has to go up. Ultimately, what this ends up doing is what it's already done in the part-time and lower end of the job market. There is essentially no such thing as a job in the lower end that is for more than 32 hours a week anymore. And the reason for that is that's where the penalty comes in as an employer. If you have people that are working more than 30 hours a week, you have to offer them health insurance. Well, the way you get rid of that is nobody works more than 30 hours a week. So you have someone that's, for example, a college student, someone who has a high school diploma and works in retail or whatever, they would have been getting 40-hour-a-week paychecks. Now they're getting 30-hour-a-week paychecks, which is a 25% decrease. And then on top of that, they're not getting offered any coverage, so they have to go into the individual market, buy it themselves. Now, if they're at the lower end of the income scale, they might be able to do that for $100 a month or thereabouts because, you qualify for the subsidies. But what does this do to your income level? Okay, it chops it back because I can't get that full-time job anymore. At the higher end of the wage scale, it kills productivity improvement because this comes off the top line. People don't see it in their paycheck, but they don't get the raise, and it hits profits. So, because let's face it, health insurance, benefits and employee costs come off your top line as an employer. So all of this means much slower growth, if any at all, because all this money is just being siphoned into the health insurance and health care system. As for Janet Yellen, she doesn't have any choice but to raise rates. We have an emergency policy rate right now that is destroying the pension funds in this country and the insurance companies. Right? This is where the pressure is coming from. It has nothing to do with the economy. It has everything to do with fixed income bond ladders, and that is a mathematical problem that Yellen has to confront. She certainly is going to take a lot of heat, but rates are going to go up. And the problem is that where you're seeing inflation is in places where you don't want it. You don't want, if you're a healthcare consumer, the last thing you want is for your medication to go from $50 a month to $200 a month, especially if you're at the lower end of the income schedule. But that's happening as well. You're having the health insurers are repricing their formularies and moving drugs into higher cost tiers, which means your copay goes up.
So she's just screwed. She has to raise rates. You're saying that she's boxed in the corner. If she doesn't raise rates, what happens?
Well, if she doesn't raise rates, you probably see a substantial rally in the stock market for a short period of time. I don't think it means anything else to anybody. But the problem is that the cost-pushing inflation that's coming out of this, because all of this excess liquidity sloshing around is going into buybacks and corporate actions like that. It's not going into production. So what you have is a production lag. There's no incentive for corporations to invest in capital equipment because they can just buy up their stock and buy up the price. Of course, everybody loves that, right? Unless you're actually trying to grow the economy at a core level. And that's what we should be trying to do, but there's no incentive to do it in a zero-rate environment. The bigger risk is that Yellen finds herself on the back end of the curve. Monetary policy has a substantial lag, about a year to 18 months, before it filters into the economy. So if she raises rates in December, which I expect she will, it's going to be a quarter of a point. Everybody will scream. A quarter point doesn't mean anything from an economic perspective. But what it does is it signals to the market that the game of rolling down interest rates, rolling down coupon costs, and increasing systemic leverage, that era is over. Okay? And that's really the bottom line here, is that valuations have been grown over the last 30 years on the basis of a secular trend. That secular trend has ended. It's mathematically certain that it has ended. So how long does the bubble remain? I don't know. But where do we go from here? Not in a positive direction.
You think, well, she can't just raise rates a quarter of a point. That's not what this is about. This is about the normalization of rates. I had Catherine Austin Fitz on, and she said, well, a quarter of a point. She said what you said. A quarter of a point won't make any much difference. I said, yeah, but but they're trying to normalize rates. What about a 1% federal funds rate? And her face was like, terror. And so, aren't they trying to normalize rates? Isn't that the real goal?
Well, sure, and the bigger problem, Greg, is that you have a balance sheet that constitutes a bunch of systemic leverage that's out in the system. Okay, that balance sheet has to be run down. Yellen knows that when that happens, that is going to increase purchasing power. But there's a problem with doing that, which is that when you put those bonds back out into the marketplace, greater supply means that there's supply and demand equilibrium, right? The price falls. Price falls means coupon goes up. But if you own some of those bonds, you now have a capital loss. You bought them when the rates were low. You can't do anything about that loss. You either realize it over the life of the bond in form of lower interest, or you sell the bond and you take it as a capital loss, crystallize the entire thing right now. The problem that you have in the economy is that the modeling has been done that says that these bonds are worth this much money. They're not, okay? And the bond market is enormous compared to the stock market. Of course, currencies are even bigger than that. So the embedded losses that are in these portfolios right now is just outrageous. It's huge. It's in the trillions of dollars, and nobody knows how this plays out, because if you just take this over the duration, it's manageable, but it's going to hurt. If people start trying to sell to get out from under these things, there could be a real crisis in the bond markets. Not so much in the Treasury side, but on the corporate side, there could be a real problem in the corporate bond market.
Do you think it could just all crash? If you start raising rates, aren't some people going to front run that trade and just sell, and the whole thing implodes? Especially when you consider all the, at least a quadrillion in derivatives, interest rate derivatives?
Well, there's certainly going to be people that are going to try to do that. How effective they'll be, I don't have any idea. But, I mean, that there will be front running that goes on, sure. There's already been some front running that's going on. There's some indications that's been happening, especially in the corporate credit market. When does the door slam shut is really the question, because, when you're in the ballroom and the punch bowl's in the middle of the table, everybody's drunk, if nobody's paying attention to the fact that curtains are on fire at the other end, you get away with that for a little while, but eventually people start choking on the smoke. So I don't know whether we get the mad rush to the exit kind of thing that you had in 2008 or not. But I am a little concerned about the buildup of systemic leverage in corporate America as a result of what we've done over the last 6 or 7 years. I think there's very real cause for concern there, especially among so-called investment-grade credits that nobody thinks are dangerous from a default risk perspective, because they're not. Companies like Apple and Netflix, and companies that have borrowed a lot of money that have fairly good investment-grade ratings. The street sees them as reasonably safe. Nobody thinks that they're not going to make the payments on the coupon. That's not the problem. The problem is that if Apple can come back to the market tomorrow and borrow, but they're going to have to pay 5% instead of 2%, then what happens to all the existing bonds that currently yield 2%? And the answer is the price falls so that their implied coupon rate is 5%. All right. Well, if you hold those bonds, you have a embedded loss in your portfolio that you can't get rid of. And the only question is, how are you going to take the loss? All at once or over the remaining duration? That's it. Well, that's the 900-pound gorilla in the china shop that nobody's paying attention to, is what is the embedded loss that's in these portfolios? I don't have an answer as to the amount, okay? But it's not small, because this imbalance has been built up now over the last 6, 7 years.
It's in the trillions, maybe the tens of trillions of losses that somebody's going to have to write off. We're going to find out that those bonds are not assets, they're liabilities.
Well, they're assets, but they're worth a lot less than you thought they were. Okay, I mean, that's the basic deal is that the price of a bond is the discounted cash flow of the coupon plus the principal, right? I mean, that's basically how it works. When there's a change in the coupon, then the base price resets, because why would if you have a $100,000 bond and it yields 2%, then it makes $2,000 a year, right, in coupon. Well, if I can buy a new one for 5%, that's a $3,000 a year difference. If it's a 10-year bond, I'm going to demand that you give me, if there's 10 years left on it, I'm going to demand that the price of that other bond is $30,000 less, minus the cost of the money, which is not zero either, because I could just buy the 5% one and get 5 a year instead of 3. And
what you're describing is the whole system, which is backed up by these bonds, assets. I mean, the whole thing could come tumbling down.
Yeah, and one of the problems with this is that it is very duration sensitive, because that's how bonds work. The longer the duration, the more the damage. So if there's a 3% difference in coupon, over 1 year it's 3%. So what? Over 10 years it's 30%. Okay?
Over 30 years, it's a lot more.
Well, yeah. So, I mean, if I have a 30-year bond that's nominally worth $100,000, but there's a $3,000 a year loss against the new one that's embedded in there, well, that bond's worth $30,000 less right now. Okay? Now, you can space out that loss over 10 years, $3,000 a year, or you can take it today, but one way or another, you're going to take it. And that's what that's what the market's not paying attention to right now, is that these changes in valuation are real, Just like what we did with QE, everyone said, "Oh, QE is wonderful. These low rates are wonderful because they stimulate spending, and you can buy a car with a 1% car loan." And yes, but the person that loaned you the money only gets 1% instead of 4. All right. By the way, the person that was getting the 4 is the grandma that used to go on a cruise every year and now doesn't have the extra income to do that. Okay, so that suppresses the economy. Then the capital loss comes in and gets you on the back end.
And we're already spiraling down. And you're saying that Yellen, your bet is Yellen has to raise rates.
Yeah, I don't think she has a choice. I think she needs to move in that direction. She has to have some dry powder. The economic indicators say that we are on the verge of recessionary conditions now. Okay. We are very likely to go into recession sometime in the next 6 to 12 months, maybe in a recession today. The Fed is currently backed into a corner because it has no tools. All right. So how does it deal with this? And secondly, from a policy perspective, let's say they leave rates at 0 and there's a recession. What is their answer to the people that say, "But you said this would not happen"?
So they're going to bring on a recession if they raise rates. They're going to amplify it. They have to.
Well, I don't think they're bringing on anything. It's been my position that quantitative easing and 0 interest rates didn't stimulate anything except leverage. So there was no growth that came out of it. We've been masking a recession that we've been in since 2007, and it's still here. I mean, yes, you're at 5% unemployment, but look at how many people are not in the labor force. Okay, look at the labor participation rate, because that's the number that matters, is the employment participation ratio. And all of the people that have been gaining jobs, statistically speaking, they were in 2 places. One was in the fracking business, which is now falling apart because of low oil and gas prices. But the only other place where it's showing up, and I've been pointing this out for months in the employment data, is in those people with less than a college education. That's all part-time job.
That's the only growth.
That's the only place it's been growing. We saw, you look at who's been getting the jobs. If you've got a college degree, you haven't seen much in the way of expansion in your employment participation ratio over the last 5 years at all.
So Yellen is going to come out around the 15th or 16th of December and say, "Yep, we're raising rates," and she's going to be the Grinch that stole Christmas.
Well,
I mean, because that's going to have a negative effect, Carl. You know that. Come on, that's the bell ringing on the bond market. That's the bottom. That's it.
Well, the Grinch has already stolen Christmas. I mean, I was shocked. I was driving around over Black Friday, and there was the local mall here had, in the middle of the day on Black Friday, it was pretty crowded. But there were a bunch of stores that were open Thursday night trying to suck people in ahead of time. And where were the people? Okay, and then you're going to Walmart and you get in, you get out. Yeah, it's busy. It's kind of like a Saturday. And everyone says, "Oh, well, Amazon got all the business." Pull the other one, guys. Yes, the internet continues to gain share. That's not. I mean, look, 80% of commerce is still happening in a brick and mortar store. Okay, that gain, while it's real and while it's a substantial percentage, doesn't make it up.
You think we're already in a recession, or you think we'll be in a recession in 2016? Where do you think we are in the recession cycle?
Well, I think you're in one now, ex-health care and health insurance. And we've been in one for over a year. But, remember, GDP counts all goods and services. So, this extraction, technically, from a formal economics perspective, keeps you out of it. What does it feel like to the person that actually has to go out and buy things? Okay? I mean, you just look at things like we sold the new car sales reports just came out, and record year, right? Well, look at the duration of financing and the amount financed.
67 months.
Yeah, I mean, it continues to ratchet up higher, and the credit scores of the people, the average credit score of the person buying new cars continues to go down. So what are we saying here? We're saying that we're pulling forward more and more demand through easier and easier credit. Didn't we do this in houses? Did we really have a good, booming, healthy housing market in 2005 and 2006? I don't think so, but that's what was reported. because anyone that could fog a mirror could buy a house with no money, right? We all know how that ended. Why are people doing it with cars? Because if you lose your car, you can't go to work. So that's the first thing you pay every month, even if you can't pay for anything else, right? But does this tell you anything positive about the health of the economy? No, you don't look at the sales numbers. You look at the credit quality and the duration of the loans that are being taken, because that tells you what's really going on in terms of the health of the person buying vehicles.
Do you think we're headed for a collapse or a crash? We have to be, by what you're saying.
Well, crash is a relative term in a sense, in that repricings always happen back to the mean. They happen slowly or they happen quickly. When they happen quickly, we call it a crash. When they happen slowly, we call it a recession or a depression, because it happens over the space of years or even decades. I would argue that we've played serial bubble blowing to the point that we're out of powder here. We're now scraping the bottom of the barrel, trying to find enough powder for one more shot out of the cannon. I don't see where Yellen manages to get away with this for any great length of time. And Draghi is trying to do the same thing. You've got, the Chinese are freaking out. But I look at industrial production. I look at basic commodity demand and freight traffic, Baltic Dry and things like this. And what I see is a global economy that has been running on fumes for the last couple of years, and cheap money has been powering it. Well, borrowing more and more, as I've pointed out repeatedly, is a great scam as long as it lasts. Because if I can make a $50,000 interest payment, but instead of having $1 million out, I can have $10 million out, as rates go from 10% to 1%, I can spend the other $9 million. But that doesn't make what I did sustainable, because it's all powered on the premise that I have the other $9 million. What happens once the $10 million is out and I can't borrow any more money because rates can't go any lower? All right? I can't borrow another $9 million. Well, that alleged economic expansion and economic progress all disappears. So now what is the valid price of a stock or of a bond or of some other asset if all of this so-called economic activity that was supposedly powered by this great economy was all vapor? I don't know, but certainly not what it's being sold for today.
I think it'll reset quickly by what you're saying. And you think so too, don't you?
Well, psychology is a funny thing. In 2000, it came out of nowhere. There was a little dinky company that announced a restatement of their earnings and an accounting problem. That was a firm that was, from a market cap perspective, they didn't mean anything. Okay? That set off the crash in 2000. 2007, you had two hedge funds, right, that blew up. Everybody knows about that. The two infamous Bear Stearns hedge funds. They didn't mean anything. They were nothing in terms of economic impact. Even if you look at the credit default swaps that were out against their stuff, there was nothing there. It was a nothing burger. But it was enough to destroy confidence, and people start waking up in the middle of the night in a cold sweat. That's what causes it to unwind. That's when people say, hey, wait a minute, this was an irrational thing for me to do. Stupid. Well, I don't know what sets that off. I don't know where the moment of recognition is, but will it come? Sure, it always does. Real value is just arithmetic. A stock is just the discounted cash flow of the earnings, dividends, and return capital to shareholders over time. That's all it is. Okay? Everything else is speculative premium. And when speculative premium becomes most of what's embodied in the price, then you have the possibility for a very rapid unwind of that when people come to their senses.
Karl Denninger, market-ticker.org. Thanks for coming on and taking us to school. You're right about Obamacare. It was going to crash the economy, and it is. And Obamacare itself appears to be crashing as we speak, and that too is unsustainable. Go on market-ticker.org and see Karl Denninger. He is a prolific writer. Karl Denninger, thanks again for joining us today on USAWatchdog.com.
Thank you. Have a good one.